Good morning, everybody. It's Monday, September 9th, 2024. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. You can find me intra-week if there's something I need to say. It'll be either on LinkedIn, Herb Morgan, or on X, ETF_strategist. Presentation you are about to see and or hear is developed by me. I work for Cantor Fitzgerald Investment Advisors. We are an SEC registered investment advisor, and this presentation is meant to be used with both financial advisors, planners, and individual investors, but each are expected to make their own investment decisions. Nothing in the presentation is investment advice, no tax advice, no recommendations for the purchase or sale of any securities. Everything is for informational purposes only. The views expressed herein are my views and may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Past performance is no guarantee of future results. You know the drill. Let's move on here and talk about, we had a pretty rough week. We had a pullback in tech, despite pretty good earnings from some big companies like NVIDIA prior week, but we just had a pullback. We've had a straight up run. It's been great, but I'm not surprised to see this. And I would call this a textbook pullback, and I'll explain to you why here. You can see here S&P down 4, mid cap down a little more, small cap down a little more. We haven't seen that in a while. That's textbook. The small and mid are more elastic. So if we had a rebound of 4%, we might expect a bigger rebound in small and mid cap. They're just higher beta equity benchmarks. We also saw something we haven't seen in a while, which is traditional behavior between stock and bond indices. As stocks went down, bonds, being the flight to safety, the conservative vehicle, caught a bid, and you can see the aggregate bond index up about 1.25%. So does this action, the action from last week, and of course, when we have a down week of 4% in the equity markets, my phone rings and y'all call, and that's what I'm here for. So please do it. Don't feel shy. But what I look at is when the stock market is selling off, what's happening to this part of the bond market, the high yield bond index. The high yield bond index, as you can see, caught a bid. If this equity sell-off was indicative of a pending recession, what you would see is that high yield would tend to move more in line or in sympathy with equities, and the spread between the yield on treasuries and the yield on high yield bonds would widen out. That's more indicative of likelihood of recession. What I saw here was sort of a healthy pullback in a market that's run a lot in the last 18 months. Moving on, we got a lot of economic data last week. Let's start with manufacturing data. Keep in mind, manufacturing is about 15% of the U.S. economy. We got two readings, ISM and the S&P reading, both below 50. Let's start with S&P. Fell from 49.6 to 47.9. The estimate was right there at 47.9. You can see we've been below 50 before. You can see it in 22, late 22 through 23. Didn't end up in a recession. This does not necessarily mean we'll be in a recession, but it is 2 months in a row below 50. Manufacturing, about 15% of the U.S. economy, definitely in contraction. This is confirmed by the reading from ISM, Institute for Supply Management, where you can see we've been really negative with the exception of a single month for the better part of 2 years. That number came in at 47.2. New orders are below 50. That doesn't bode well for future manufacturing activity. Production well below 50 and employment well below 50. So nothing pretty happening right now domestically in manufacturing. Where things are better is in the services sector. S&P Global U.S. Services PMI came in at 55.7. So you have to go all the way back here to early 2022. So we're talking about 2.5 years. It's the highest reading in 2.5 years in the services sector. And the services sector represents about 85% of the U.S. economy. So despite the slowdown in manufacturing, it would be very hard to conclude that a recession is here or imminent, though I'm going to show you some data soon that could make you conclude that. Let's take a look at the other services reading from ISM, the Institute for Supply Management. Rose a little bit, just a little above 50. You can see nothing like the post-COVID coming back out economy data, but 2 months in a row, they're solidly above 50. New orders above 50, business activity above 50, employment still hanging in there above 50. So services, much bigger part of the economy than manufacturing, still showing expansion and growth. Construction spending in the month of July fell 0.3%. That was a surprise because we're estimating, a 0.1% gain. Okay, is what it is. We kind of know a lot of construction spending is dependent upon financing. If I was a builder or a speculator or a syndicator or any of those things, and I was going to build and develop, I would probably try to put it off till the first couple of rate cuts are on, just to get my financing costs down and see some stability in those markets. We also had a negative trade deficit report. Now, a trade deficit is a subtraction from GDP. When we import things, the way we calculate GDP, that subtracts. When we export things, that adds to GDP. If you have a net deficit, which we obviously do persistently and consistently have a trade deficit in this country, that is a subtraction from our very large GDP, $28, $29 trillion GDP. The deficit came in at minus 79 billion. That's the largest reading in the past 2 years. Imports rose significantly. So, is this some kind of recessionary sign? No. Is this a sign that the consumer is very strong? Could be. But as we look further, what we found is that there was a big surge in imports as companies decided to stock up ahead of a sort of known to happen, likely to happen, dock worker strike on the U.S. And then in addition to that, obviously we're in an election. The election is coming soon, 60 days, less than 60 days away, and then a new president in January, on January 20th. And one of those presidential candidates, President Trump, is a big fan of using tariffs to level the trade playing field. More tariffs would make those imports more expensive, so companies are getting ahead of that and importing supplies and products and different things that they need now. So this would not be a reason to draw a conclusion of any sort of imminent recession. We also saw a surge in factory orders in July of 5%, but we know factory orders encapsulate many things, including very large transportation orders, very large planes, military aircraft. Those things go into the factory orders number. If you back that out, we had a more tepid 0.4% rise in factory orders in the month of July. Automobile sales softened again. Total annualized sales of cars in August fell from 15.8 to 15.1, a little bit below the estimate there. Okay, no big deal. We move on and we really get into the thing that matters. Because the Fed is sitting here saying, hey, we're trying to fight inflation. We need to get that rate of inflation down. We know what months are falling off. We think we have an idea of what the data for months coming on. But we have to do this by slowing the economy, slowing aggregate demand, bringing pricing pressure down, but not getting people to lay off their employees. That's a very difficult thing to do. Some would say maybe it's even impossible to do. In July, job openings began to fall, or they've been falling rather for 2 years, but they're now back more in line with this long-term trend going back to the post-financial crisis numbers. And JOLTS, or job openings, still exceed the number of unemployed workers, but at 7.7 million, it would be easy to conclude that this is far less inflationary than having 12 million job openings in the economy. But weekly claims for unemployment, which are one of the best real-time indicators of weakness or strength in the labor market, weekly initial claims for unemployment came in at 227,000. That's a very low number. There's no big layoffs going on across the economy. The layoffs that are happening are being followed by hires. We still have 7.8 million job openings and continuing claims for unemployment. That's people sitting on those unemployment rolls and looking. Actually, was down a little bit last week. So the Fed, we all know the Fed's going to cut interest rates next week. I don't think they should. You know that. I didn't think they would until we obviously got closer. They began to telegraph what their plans are, which they do. They're trying to do this well before the job market softens. The risk of doing it before the job market softens is that you could not hit your inflation target, or you could reignite inflationary pressures. Economies, underlying fundamentals of the economy remain quite strong. We then got into the two jobs reports, one from ADP, Automatic Data Processing, and the other from the government, the Bureau of Labor Statistics. ADP says that private companies added 99,000 jobs, well below the 145,000 estimate. And we took the July number and we revised it down from 122 to 111. That's 11,000 less jobs than we thought we had added. Same kind of report out of the Bureau of Labor Statistics of non-farm payrolls. They say we added 142, below the estimate, so a disappointing report of 165. And then July, which had been reported at 114, was revised lower to 89. So certainly what we learned is that July which was okay, was not as okay as we thought, and August was soft. Unemployment, though, fell from 4.3 to 4.2. I would say that's a number that's widely considered full employment in the economy. The inflationary pressures you saw from the JOLTS report and you see from this is definitely starting to come out of the jobs market. I certainly wouldn't call it deflationary, and I certainly wouldn't call it recessionary. This is just sort of a normalization from the post-COVID reopening pressures that certainly existed. Another one of the arguments against the rate cut and an impending recession would be this Bloomberg United States Financial Conditions Index. This is a little bit busy, but the white line, when it's above zero, here's zero. I'm going to just draw a line across at zero. That says financial conditions are generally loose, financing is available, money is available for business ventures, for spending, for lending, all of those things. Banks are making loans, and the economy is okay. When the number goes negative and goes below zero, it means financial conditions are tightening. And if money's not available, the economy can't function. And if it functions less or is diminished in any way, that can lead to a recession. So financial conditions, you can see over here on the left, went down, we ended up recession. Financial conditions came down below zero, recession. Down below zero, recession. Down below zero, recession. Pretty consistent. Here we are, still above zero. Now, we did have a below zero here in 2022 and did not enter a recession. So we have strong financial conditions. This would argue against the Fed rate cut now. And of course, there's a lot of people like myself that believe that the Fed should do the most to maintain its credibility. And the way to maintain your credibility is to not cut interest rates directly ahead of a presidential election. Your way to maintain your credibility, unless there's this major compelling reason, oh my God, we have to cut right now, jobs are being lost, financial conditions have deteriorated, then sure, do it. But right now, what you want to do is you want to maintain your credibility with the world. And in cutting directly ahead of a presidential election, I think diminishes the Fed's credibility and signals that maybe it's not quite as independent thinking as it should be. Now, on the other hand, to be fair, to take the other side of that, you've got the spread between 2-year and 10-year treasuries. So when the spread is positive and high, that means that the yield on the 10-year treasury is above the yield on the 2-year treasury. And that's called normal. That's a normalized yield curve. If you invest for a longer period, you get a higher interest rate. However, when the Fed starts raising short-term interest rates, it can drive the 2-year with it, drag the 2-year higher with it. It goes above the 10-year, the curve is inverted. It's often said that recessions are preceded by a yield curve inversion, where the yield on the 2 is higher than the yield on the 10. You can see it over here, the red being recession. You can see it here. You can see it here. You can see it here. All of those instances of recession, we had an inverted yield curve ahead of the recession. And then the curve disinverted right before the recession hit. Why did it disinvert? Because the Fed is starting to cut rates, or is widely expected. Like now, they're going to cut next week. That's the same as having cut now, because the market is adapting to that. The market is efficient. So here we are. We inverted, and we have now just disinverted. Does that mean a recession is imminent? No, it doesn't mean it. But you can see you can certainly make the argument and the case for it. And so you have some data that argues that a recession is imminent, like this, other data that argues that it's not, like the financial conditions and the job openings, etc. Finally, we move on to this recession probability index from Bloomberg Economics. You can see that this here, when that rises significantly, tend to have a recession. We were at 25% back here in 2000, and we got a recession. We were at about 25% in 06, 07. We got a recession. We were at about 24.3% in 2019, 20. We got a recession. Today we're at 30%. So the recession odds are certainly elevated. I don't think the Fed should do it. You know why I think the Fed will. But I understand why they're doing it. They're looking at things like this and saying, hey, the odds of recession are elevated. The job market is softened. We have some visibility on inflation. We're going to go ahead and cut now. We're going to try to achieve what very few central banks have ever achieved, which is this perfect soft landing. Nobody loses their jobs. The economy expands again without inflation. Incredibly difficult to do. It's another reason why I think we should just wait until after the election. But anyway, the economic data this week, we've got consumer credit looking for 12 billion, small business optimism. Most important data this week is going to be CPI and PPI. If for some bizarre reason there was an acceleration above these numbers, 0.2, then it would be a shock to the market, and it would say, no way is there a cut coming in next week. But I don't see that happening. So I see these numbers being kind of as expected. Weekly finished for unemployment expected to be very low, import, export prices, and consumer sentiment. Thanks for tuning in. As always, don't forget, the best place to watch this is on the YouTube channel because you get the graphs and charts, my pretty face. Or if you're driving, tell your smart device to play Slaying Bulls and Bears by Herb Morgan. We try to make the complex and complicated as simple and sensible as we possibly can. We're available on all the audio podcast formats. Thank you. And I'll be back to you again this time